Hey there, thanks for joining us at CashOps, where we decode the stock market for you. Today, we're diving into some intriguing investment opportunities and a few red flags to watch out for in the current market. Are you ready to see if these are potential gold mines or hidden pitfalls? Let's get started without any delay. Our first spotlight is on Kotak Mahindra Bank. Have you noticed its recent price dip? From a high of around 1,900 at the beginning of the year to roughly 1,620, that's a steep 15% fall. Interestingly, a significant chunk of this plunge happened in just a couple of days. Now, what's behind this sudden drop? The bank faced regulatory challenges from the RBI regarding new customer onboarding and issuing credit cards due to IT compliance issues. But here's the kicker. These problems didn't just appear out of nowhere. They've been brewing since 2021. Despite these hurdles, the bank's financial health, like its net interest margin and asset quality, remains robust. But how about its valuation? Even after the drop, it's trading at a high price-to-earnings ratio compared to its peers. What does this mean for you as an investor? We'll dive into whether this presents a buying opportunity or if caution is the better part of valor. Enjoying the analysis so far? If you find our insights helpful, consider hitting that subscribe button to stay updated with our latest videos. Moving on to Tata Elxsi, a tech giant that's seen an 18% correction this year. This drop brings it back to levels last seen in mid-2023. This correction stems partly from valuation adjustments and fundamental changes, including a noticeable dip in its quarterly performance. The company is facing challenges, particularly in its media and communications segment. However, it's investing in AI and talent, which could be a strategic move for long-term growth. Is this dip a buying signal, or should investors tread carefully? We'll explore the factors that could influence Tata Elxsi's rebound potential. Next, let's paint a broader picture of the market with a focus on the paint sector. Companies like Asian Paints, Burger Paints, and Nerolac have seen their stocks tumble by around 16% this year. This sector is notorious for its cyclical nature, influenced heavily by raw material costs and economic sentiment. With current geopolitical tensions affecting oil prices, the paint sector's margins could be squeezed further. But is this the right time to brush up on your investments here? Or should you wait out the volatility? Investing in artificial intelligence, AI stocks in 2024 presents a unique opportunity for investors looking to tap into one of the most transformative technologies of our time. As AI continues to integrate into various industries, from healthcare and finance to automotive and entertainment, its growth potential could be substantial. However, like any investment, it comes with its own set of risks and considerations. The growth potential of AI. AI technology is at the forefront of the next industrial revolution. Companies leveraging AI to enhance operational efficiency, improve customer service, and innovate product offerings are seeing significant competitive advantages. For example, AI's application in data analytics allows businesses to parse through vast amounts of data to identify trends, predict consumer behavior, and make more informed decisions. This capability is invaluable across sectors, driving demand for AI technologies and the companies that provide them. In healthcare, AI is revolutionizing diagnostics and patient care, with algorithms that can predict patient outcomes and assist in complex surgeries. In the automotive industry, AI is the backbone of autonomous driving technologies, a sector that is expected to grow exponentially as regulations and technologies mature. Investing in companies at the forefront of these AI applications could offer substantial returns as these technologies become mainstream. Risks and considerations. However, investing in AI also comes with risks. The technology's rapid development means that it is subject to regulatory scrutiny and potential privacy concerns, which can impact the stock prices of companies involved in AI. Moreover, as more companies enter the AI space, the competition intensifies, potentially diluting the market share of established players. Another risk involves the hype surrounding AI technologies. Investors must distinguish between companies with genuinely robust AI capabilities and those that merely capitalize on the AI trend without substantial offering. This requires thorough research and sometimes a technical understanding of what makes AI applications effective and scalable. Strategic investment approaches. For those interested in investing in AI stocks, diversification is key. Consider a mix of established tech giants with proven AI capabilities and emerging companies with innovative solutions and potential for high growth. Exchange-traded funds, ETFs, focusing on AI and technology, can also be an excellent way to gain exposure to a broader range of AI opportunities, while mitigating some of the risks associated with individual stocks. In conclusion, as we move into 2024, AI stocks represent both significant opportunities and notable risks. Investors should stay informed about technological advancements and market trends, maintain a diversified portfolio, and remain vigilant about the companies they choose to invest in within the AI domain. This approach will enable them to potentially reap the benefits of AI's integration into global industries while managing the inherent risks of this dynamic sector. As we look ahead to 2024, the landscape of the U.S. stock market presents both opportunities and challenges for investors. Following a period marked by unprecedented monetary policy shifts and global uncertainties, the market is poised at a pivotal juncture that could shape investment strategies for years to come. Economic outlook and market trends. The U.S. economy, resilient in many respects, continues to grapple with the dual challenges of inflationary pressures and interest rate hikes. The Federal Reserve's actions throughout the previous years have been largely focused on tempering inflation without tipping the economy into a recession, a delicate balancing act that has significant implications for stock performance. For the stock market, these macroeconomic factors translate into a heightened state of volatility and a shift in investment paradigms. Traditional high-growth sectors, such as technology and consumer discretionary, might face headwinds if borrowing costs continue to rise. Conversely, sectors like utilities and consumer staples, often considered safe havens during economic turbulence, could see more stability or even growth. Sector-specific implications. In technology, the rapid evolution in areas like artificial intelligence, cybersecurity, and cloud computing offers growth potential. But these gains could be tempered by tighter financial conditions, affecting startup funding and consumer spending. Financial sectors might benefit from higher interest rates, improving margins for banks and financial institutions. Energy stocks could continue their revival as global demand stabilizes, and if geopolitical tensions in key oil-producing regions persist. Healthcare remains a robust sector, with ongoing innovation and an aging population driving demand for medical services and biotechnological advancements. Investment strategies. Navigating the U.S. stock market in 2024 will require a keen eye on both domestic economic indicators and global events. Investors may benefit from a diversified portfolio that includes sectors poised to grow in a changing economic landscape and those that provide stability amid uncertainty. Keeping abreast of Federal Reserve policies will be crucial, as their decisions on interest rates will directly impact market liquidity and investor sentiment. Overall, the U.S. market in 2024 demands a strategic approach, balancing the pursuit of growth opportunities against the backdrop of economic recalibration and ongoing global challenges. As we wrap up today's episode, remember, whether it's taking a chance on Kotak Mahindra Bank, analyzing the tech prowess of Tata Elxsi, or mixing it up in the paint sector, informed decisions are your best tool for navigating the stock market. Did you find our insights useful? Give us a like and subscribe to CashOps for more in-depth analyses and tips to help guide your investment journey. Thank you for watching, and remember, keep your investments smart and your returns high.